Today on Your Government in Action, where we cover bills, votes, records, and how it affects you. Congress handed corporations a permanent tax cut in 2017, but gave you a temporary one that runs out in 2025, and most Americans still don't know the difference. In December of 2017, Congress passed the biggest tax overhaul in 30 years. They called it the Tax Cuts and Jobs Act, and here is the part that most people missed. The corporate tax cut is permanent, your tax cut is not. The law added $1.5 trillion to the national debt over 10 years, according to the Congressional Budget Office. The top 1% of earners captured roughly 17% of the total benefit. Whether that was a good deal depends on who you ask, but the facts are the facts. Let's walk through exactly what changed, who voted for it, who benefited, and what happens next. Let's start with what the law actually changed. The Tax Cuts and Jobs Act ran over 500 pages, but the core of it comes down to a handful of big moves. First, the corporate tax rate. Before 2017, the United States had one of the highest corporate tax rates in the developed world. The top rate was 35%. The new law cut it to 21%. That is a 14-point drop. And here is the key detail. That cut is permanent. It does not expire unless Congress passes a new law to change it. Second, individual income tax rates. The law lowered rates across most of the 7 tax brackets. The top rate dropped from 39.6% to 37%. Middle bracket rates dropped by 1 to 4 percentage points depending on your income. But these cuts have an expiration date. They are set to expire after December 31, 2025. Unless Congress acts to extend them, your rates go back up automatically. Third, the standard deduction. The law nearly doubled it. For a single filer, it went from $6,300 to $12,000. For married couples filing jointly, it jumped from $12,600 to $24,000. That change made it far less worthwhile to itemize deductions for most households. As a result, the number of Americans who itemize fell from about 30% to around 10%. Fourth, the estate tax exemption. The threshold before estates owe federal tax doubled, from $5.5 million per person to $11.2 million per person. That change also expires in 2025. Fifth, the child tax credit doubled, from $1,000 per child to $2,000 per child. That one also expires. The pattern is consistent. Corporate changes, permanent. Individual changes, temporary. Now let's talk about how this bill actually became law, because the process was unusual. The Tax Cuts and Jobs Act moved at a speed that surprised even seasoned Washington observers. Republicans had promised major tax reform for years. After winning the White House and controlling both chambers of Congress in 2016, they had the votes to deliver. The House passed its version of the bill on November 16, 2017. The Senate passed its own version on December 2nd. The two chambers then had to reconcile their differences in a conference committee. The final bill cleared the House on December 19th and the Senate on December 20th. President Trump signed it into law on December 22, 2017. From introduction to signature, less than 7 weeks. For a bill this complex, that is extraordinarily fast. The process bypassed the normal requirement for 60 Senate votes by using a procedure called budget reconciliation. Under reconciliation, only 51 votes are needed in the Senate, not 60. That meant Republicans could pass the bill without a single Democratic vote. And that is exactly what happened. Not one Democrat in the House or Senate voted for the final bill. Republicans used reconciliation because the law was written with expiring individual provisions. Under Senate budget rules, a reconciliation bill cannot permanently add to the deficit beyond a 10-year window without violating the Byrd Rule. So the individual tax cuts were made temporary specifically to comply with that rule. The corporate rate cut was structured differently and did not trigger the same limitation. That procedural decision, made in a committee room, is why your tax cut has an expiration date and the corporate cut does not. It was not accidental. It was a deliberate choice to make the math work within the rules. So who actually voted yes, and who voted no? In the House, the final vote was 227 to 203. Every Democrat voted no. 12 Republicans also voted no. mostly from high-tax states like New York, New Jersey, and California. The reason: the law capped the state and local tax deduction, known as SALT, at $10,000 per year. For homeowners in expensive states, that was a painful change that offset much of the individual rate reduction. In the Senate, the vote was 51 to 48. Again, every Democrat voted no. One Republican, Senator Bob Corker of Tennessee, also voted no. He cited concerns about the national debt. Senator John McCain, who had blocked the Republican healthcare repeal just months earlier, voted yes on this bill. Senator Lisa Murkowski of Alaska and Senator Susan Collins of Maine, both of whom had also opposed the healthcare bill, voted yes on the tax bill after receiving assurances on specific provisions. The final Senate vote happened in the early morning hours of December 2, 2017, a Saturday. Several senators received their copies of the final bill only hours before the vote. Some pages had handwritten margin notes because changes were still being made. Critics called it reckless. Supporters called it necessary speed. The bill's total cost over 10 years was estimated by the CBO at $1.5 trillion in additional deficits, assuming the individual cuts expire as written. If Congress extends those cuts, the cost grows significantly. A 2021 CBO estimate put the cost of a full extension at another $1.4 trillion over 10 additional years. Now let's look at what actually happened after the law took effect. The law took effect January 1, 2018. Here is what the data showed in the years that followed. Corporate profits rose sharply. The after-tax profit margin for S&P 500 companies increased significantly in 2018, partly because of the rate cut. Stock buybacks hit a record in 2018, with corporations repurchasing around $1 trillion of their own shares, according to S&P Global. Critics argued this was shareholders benefiting, not workers. Supporters argued it reflected business confidence. Wages did increase modestly in 2018 and 2019, though economists debate how much of that was due to the tax law versus the broader economy, which was already growing. The unemployment rate continued its downward trend, reaching a 50-year low of 3.5% in 2019. Whether the tax law caused that, contributed to it, or simply coincided with it is a matter of genuine debate among economists. On the individual side, most Americans did see lower tax bills in 2018 and 2019. The Tax Policy Center estimated that about 65% of households received a tax cut, roughly 22% saw no change, and about 6% paid more. Those paying more were concentrated in high-tax states where the SALT cap hit hardest. Corporate tax revenues fell significantly. In the fiscal year before the law, corporate taxes brought in around $300 billion. By 2019, that had dropped to around $230 billion. The Congressional Budget Office estimated the total 10-year impact on the deficit at $1.5 trillion, even accounting for some economic growth effects. So what does all of this mean for you right now? Here is where things get personal. If you file a federal tax return, the Tax Cuts and Jobs Act has been shaping your tax bill since 2018, and right now, in 2026, that is about to change. The individual tax cuts expire at the end of 2025. Congress has been debating whether to extend them. If they are not extended, here is what happens automatically. The standard deduction shrinks back down. Tax bracket rates go up across the board. The child tax credit drops from $2,000 per child back to $1,000. The estate tax exemption drops back to roughly $6 million per person, adjusted for inflation. For a single filer earning $60,000 a year, analysts estimated the expiration could mean roughly $1,500 to $2,000 more in federal taxes per year. For a married couple earning $120,000, the number could be $2,000 to $4,000 more per year. The SALT cap stays in place unless it is also changed by new legislation. That is a separate fight. The corporate rate stays at 21% regardless of what happens with the individual provisions. That rate is permanent law unless a future Congress changes it. So the stakes in 2026 for the extension debate are real for working families. This is not an abstract policy debate. If Congress does not act, your taxes go up automatically. You do not have to vote, sign anything, or do anything wrong. the cuts simply expire and the old rates snap back into place. The Tax Cuts and Jobs Act is one of the most consequential pieces of legislation passed in a generation. It permanently changed how corporations are taxed in America. It temporarily lowered rates for individuals and families, and it added over $1.5 trillion to the national debt in its first 10 years. Now, in 2026, Congress is in the middle of deciding whether those individual cuts live or die. Whatever they decide will directly affect your paycheck. That is exactly the kind of decision this channel exists to cover. If you want to stay informed about what Congress is actually doing and how it affects your wallet, subscribe to Your Government in Action for more breakdowns like this.